You are listening to chartingwealth.com for Monday, the 28th of March, 2016. We jump into the market as we always do with IYY. That is the Dow Jones U.S. Total Market Index Fund. We saw the market rotate and go up on our two-day chart back on the 16th of February. And what has it done? Well, it rose steadily, the total market did, until a little bit of a quirk around the 9th of March. And then, of course, the last two-day candles on the 23rd of March, and then again on the 24th. That candle is still completing, but those ended up being down candles. We broke our two-day trend line as of Thursday, which was the last trading day of the shortened week with Good Friday on Friday. The markets are closed, but we saw the two-day candle trending down. Our derivative oscillator has been losing speed. Our MACD is approaching, the blue MACD line is approaching the red signal line. If we look at what is happening intraday, we see on the 4-hour chart that we crossed over in the morning. Technically, the total market was down just 0.07%, so not even a full percent. But we crossed over on the derivative oscillator right about the time that the 4-hour chart rotated over going down. The derivative oscillator has heated up substantially, and the market went down strongly in the morning and then up some in the afternoon to cut those losses. But that's where it ended. We have breached our two-day trend line. That is always a warning signal. We'll have to look for an ability at some point to redraw that, possibly on a down move. If we don't see up movement at the beginning of the week, we are still in a confirmed up move, though, on the big chart. On the two-day chart is where we stand. So hasn't crossed over going down yet. If we see the 4-hour chart rotate over and start to go back up, rotate over on that 4-hour trend line, 4-hour chart rather, we will then be looking to purchase back in on up moves, but we do not have a purchase right now. Let's look at S&P 500, down for the day 0.04%. We see a very similar pattern on the S&P 500 as we saw with the total market. Sometimes listeners or viewers ask me, why does the chart on the S&P 500 mimic many times closely but not the same as the total market? It's because the S&P 500 are 500 big companies with a lot of the volume of the market in it, so sometimes that looks very similar. We're still in the positive on the derivative oscillator on the big chart, although the derivative oscillator is losing energy. MACD line does seem to be coming closer to the signal line, but it hasn't crossed over yet. Like I said, down 0.04 for the day. On Thursday, if we look at the 4-hour chart, looks similar to what we saw in the total market, crossed over in the morning over the two-day trend line, up some in the afternoon to pare those losses down. Derivative oscillator is in the negative. We crossed over going down actually in the S&P 500 before the IYY crossed going down on that 4-hour chart. So that is where we stand on the S&P 500. We're going to range back out to our two-day chart. And again, we don't have any buy or sell signal at this point where should have already made those decisions. Now that we have a bit of schizophrenia with the big chart going in one direction, small chart going in another, that is not a time to be looking at getting into positions. Now, the Qs, where are we on there? Well, the Qs is down the Qs is actually up 0.03% for the day. Those of you who are looking at the charts and not simply listening are seeing that the Heikin Ashi type candlesticks are actually showing a red. That's because they are charted differently than your typical candlestick. And again, Heikin Ashi, that's Heikenen Ashi. In fact, we're going to do another training on that this weekend, so pay close attention. That should be coming out soon. It's the best kind of candlestick we believe in using. It's the only kind that we actually look at. We think it charts real flow a whole lot better than just a standard candlestick and a whole lot better than any of the other visual devices to see the way that stocks, commodities, indexes are moving price-wise. What do we see going on? Still in the positive, all the derivative oscillators losing energy on the Qs. Also, the MACD and the signal line are coming close together, if not crossed, but the 2-day trend line has been violated. Like we said, though, the Qs is up technically for the day 0.03%. So we still have that going for us. If we look at the 4-hour chart, we see lots of down moves in the morning, paired those losses in the afternoon with an up move, and we don't have a violation of the 2-day trend line yet on the Qs. So we do have a crossover back on the morning of the 23rd going down on the short chart, and the derivative oscillator heated up. Now lastly, we're going to go back to our 2-day chart, and we're going to look at gold. Again, gold has been going down as predicted, as our charts showed. And again, if you're in an inverse gold fund doing a virtual trade, you are doing quite well. Crossed over going down on the 15th, then sort of slid sideways on the next two 2-day charts on the 17th and the 21st. Then started plunging again on the 23rd and the 24th. That 2-day candle on the 24th will be completed on Monday. Has not been completed yet as far as the market closing on Thursday. So what do we see on the intra-day action on the 4-hour chart? We see that the market has continued to move down. It actually could be trying to find a floor, although it hasn't done that yet. We see a an actual wick on the bottom from the morning of the 23rd, and the market has tried to move down in gold to hit that. Of course, it crossed over on the 4-hour chart back on the afternoon, or the morning actually, of the 21st. So gold continues to move down as we saw it penetrate back several days ago the 2-day trend line, and as the 2-day trend line, the 2-day chart has also moved over, gold is moving in that same direction on the short chart. Those of you who are in inverse gold are doing quite well. That is where we ended the market as far as the daily review goes on Thursday, as we prepare for Monday the 28th when the markets reopen after the Easter holiday. Don't forget, we'll also be putting out over the course of the next few days prior to Monday the weekly review and forecast, the most popular thing that we do every week. If you have questions, concerns, needs, we love to hear from you at chartingwealth.com. Sign up for our daily podcast. What will you receive? Well, you'll receive an email with a link to it. We provide that to you every day along with the weekly review and forecast, and you will have a link to how to read a stock chart video along with our charting layout from freestockcharts.com. Thank you so much for listening. We love to hear from you. Sign up for the newsletter. Follow us on Facebook, Twitter, Google, Instagram, YouTube. You name them, we are there. From Charting Wealth,